Welcome back, investors, to Ticker Time News. I'm Adam, and the last trading day of October is now behind us, and tomorrow is the first trading day of November. Now, with October behind us and November in front of us, what performs best in November? Well, in just a couple of minutes, you will have the answer to that question as to what to be looking for the best performer in November. All right. Now, for October, we have to, well, first, let's wipe off today. It was a red day in the market. Everything was down 0.25% to 0.75%. The Qs were the worst at 1.6% down. But the IWM, that was flat. So small caps are still holding it together, all those short squeezes, you know. Now, before we look forward into November, let's talk about this real quick. The Dow Jones, and the ticker symbol, it's on your screen. DIA is the ticker if you want to trade the Dow Jones. The Dow Jones, the Russell 2000 or small caps, which the ticker is IWM, and the S&P Mid Cap 400, which are your mid cap stocks, ticker symbol is MDY. All three logged double-digit gains for the month of October. Now, the Dow, it had its best monthly performance going all the way back, not to 2021 or 2020 or even 2019, not even 1980. We have to go all the way back to before I was born in 1976. Yeah, to find a better month than this past October for the Dow. The Dow cleared 14%. You can see it here, this blue shaded box on the screen. It is counting October, and you can see up here in this white box above it, 14.03%. The Dow had its best monthly performance going all the way back to 1976 with a 14% gain. Now, looking back, still, I want to pull up the seasonality chart here, okay? Got lots of charts here to look through. How's it going? Chop City today and tomorrow? Yes, it will be. Even for the rest of this week. Oh my gosh, I have to talk about the Fed. That is coming up very, very soon. Real quick, the S&P 500 midterm election year seasonal pattern going back to 1946. Now, the red line is the line that we've been following all year long. It is when we have a second year, first term Democrat president, which we do in Joe Biden. And if we look here, let me get my highlighter real quick. If we look, we hit on this chart the June low, we hit on this chart the September low, and we hit on this chart the October low and the much bigger intraday super low of the year. Both occurred in October. So all three of these lows have been confirmed with this chart and in real life as well. Let me go back to the SPX, which is the ticker that I use for the S&P 500. We're on a daily time frame here, so every candle equals 1 day. Now, as I tighten this chart up here, I'm just going to get 2022 on the chart. And we're not going to get the very top of it. I'm not going to mess it up that far. But you can see we have fallen pretty darn far this year. As a matter of fact, let's see where we're at. 18.9% down on the year, where it stands after a end of October rally. And if we look at the seasonality chart, what do we get? Let me take those lows off here. On the seasonality chart, okay, seasonality of October, it's played out almost as well as it could. We had the weakness in mid-September, right? Even though the chart here called for a rally at the beginning of October, We did, the very first week of October, we did get a rally, but then the middle of this seasonality chart was a little mixed up, I would say, as far as when these lows occurred. And again, this isn't exact rocket science here. This is just an average going back to 1946 for the very specific midterm election year that we are in, right? But then in the second half of October, going into November, we have this rally off the low, right? And if we go back here and look on the chart, we have that rally. Let me get my highlighter real quick. We have that rally off the mid-October low right here, all right? So the dates don't line up perfectly, but they are so darn close. But now if we're looking at the seasonality chart, I've got to be honest here. This pattern seems to be saying that November isn't going to be the best month for the S&P 500, for the SPY. I would have to agree. If we look at what occurred in October, right, the bullishness was with the mega caps and the small caps. They did really well. Even the SPY, it did good in October. What did poorly in October were the Qs or the NASDAQ, right? The Qs and the NASDAQ, they did poorly. So there's two things to watch out for here in November. Number one, the bullishness at the end of October, especially for small and mid caps. Small and mid caps. So monitor the IWM, that is small caps, and the MDY, that is your mid caps. And watch for them specifically above their 50-day moving average. So let's go over here to the chart. Let's first look at the IWM, and then we'll look at the MDY, okay? IWM and its 50-day moving average. It is above it. It has closed above it, and it has been above it now for several days, okay? And here's the new weekly expected moves for the IWM as well. In case you're not a part of our private investor community, I give out the weekly expected moves to numerous products, including this week. I tried something new with giving out the weekly expected move for a, what was it, about 8 or so stocks that have their earnings this week. So I put those on the weekly expected move chart for this week as well. For the IWM, the upper end of the weekly expected move is at 189. What does that kind of correspond with? That corresponds with the 200-day moving average, which is at 187. So this red box up here, this smaller zoned red box right here, watch this area for the IWM this week. It is going to be a critical area as long as the Fed doesn't ruin the party, okay? The Fed can ruin the party, and I'm going to talk about the Fed in just a moment. But strictly technically speaking, doing technical analysis on the chart, ignoring the macro 500-pound gorilla in the room, the Fed, let's ignore them for just one moment. Technically speaking, the IWM, your small caps, has a really good chance to get to that upper end of the weekly expected move. Again, minus what the Fed could potentially do. Technically speaking, it's on that path. And right now, if we look at the volume shelf profile, let me just slide this over a little bit. And let me do this real quick. I want to clean up this corner. If we look at the price point right here, Oh, I got to slide it over just a little bit so we can see both where we are now and this. Okay. So right now, where we are now on the chart is kind of inside, getting ready to cross within. Hold on, let me get the highlighter. If you notice, there's this gap right here on the volume shelf profile where it dips down. This gap right here means that it's pretty easy sailing for the IWM to get up to, let's call it right there. Let's call it 185, okay? It's real easy for the IWM to get to $185 a share because of this air gap here in the volume shelf profile. That means there's not a lot of sellers and there's not a lot of buyers in that area. It's kind of a weak spot, okay? A weak spot. And whenever you have a weak spot in the volume shelf profile, that means I call it an air gap. And it basically means that the stock, the equity, whatever the case may be, has an easy time going through it. There's not a lot of resistance there. And if it's coming down, then there's not a lot of support there to hold it up. But once we get to 185, 186, all the way up to the weekly expected move, there is a lot of sellers in that area, okay? So once we get up to, 186, all the way up to 189, there will be some resistance there for the IWM. But it's going to have, I think, no problem getting up to that 200-day moving average minus the Fed, okay? So you've got that for the IWM. Now, the lower end of the weekly expected move doesn't mean we're going to touch it, but it's there to help manage our risk, and it's at 176, okay? Now, if we look at the mid cap, MDY, now, I do not do a weekly expected move for the MDY, but I'm going to add that. MDY, add to weekly expected moves. I always want to have this list updated for you guys because they're so important. They help me out dramatically throughout the week of knowing when to, go long, go short, when to do it. They help out tremendously. Okay, you can see the setup here for the MDY is very similar to the IWM, right? These are your mid-cap stocks right here. And if we look where it's at right now, there is from here, where we are, oh, come on, highlighter. There's an air gap on the volume shelf profile from here, and it goes up to right about here at the weekly expected move. I'm sorry, at the 200-day moving average, which would most likely probably be pretty darn close to the weekly expected move. So the mid caps going from where it is now up to its 200-day moving average, which right now sits at 453. 453 is where that 200-day moving average sits. I think the mid caps would have no problem getting up to that 200-day moving average and then maybe find itself some resistance. All right. So that 200-day moving average again is at 453. Okay. So that's your IWM and your MDY, your small caps and your mid caps. They typically perform good in November, and they've been on fire recently, but definitely watch them as long as they can stay above the 50-day moving average, they should do really well. And I think, and again, as long as the Fed stays out of the way, they could easily get to their 200-day moving averages, both for the IWM and the MDY. Now, there was some likely hesitation if we go and look at today's market, right? And what happened today. And I'm going to get to the best performer here in November. But let me get this chart moved up and straightened out so we can all see this together. Oh, come on. All right, I'll just let it load. Now, there was likely some hesitation today, right? We also got overextended. Risk also grew on Friday, right? We had a big day on Friday. Risk grew. That means our risk reward ratio was leaning more towards risk than reward because of Friday, right? So today being red, it's not a big surpriser to me, okay? It doesn't surprise me at all. Let me open this up. And as a matter of fact, I do believe on Friday's live stream, I said, yeah, today could easily be a red day. All right, let's pull this up out of the weeds. And one of the big reasons is that 5-day EMA, right? We've got to connect to it. Even with the pullback today, we are disconnected from that 5-day EMA. Tomorrow being red would not surprise me either, right? Because we need to reconnect to the 5-day EMA. I've said it multiple times. It's like a circuit board, right? And if the lines aren't connected, the circuit's not going to pass through. So today's candle is disconnected from the 5-day EMA. It needs to reconnect and make that circuit whole so the electricity can pass through. So it wouldn't surprise me at all if tomorrow's red. Now, the hesitation today is purely due to the November 1st and November 2nd FOMC meeting, okay? And the big one, the rate hike decision. Now, at 2 p.m. Wednesday afternoon Eastern, we'll get a press release, and it will have the rate hike decision. That will be followed up by Fed Chair Jerome Powell and his press conference at 2:30 p.m. Eastern. And we all know how those go, right? Most of the time, they're a shock to the market. The market can rally, it can sink, it can rally, it can be very volatile. And then the market will pick a direction. And a lot of times this year, that direction's been down. It's just been a big sell-off. But we have to listen to what Jerome Powell says. What he says is more important than how high the rate goes up, I think. The hesitation was related to Mr. Powell's press conference and whether or not his comments will signal a softer approach from the Fed starting at the December meeting. Let's look at this real quick. You guys know it. I pull it up quite frequently. This is the CME Fed Watch tool. This tells us what market participants, what analysts are putting on a probability of how high the Fed will raise the rates, the Fed funds rate. So the Fed is expected to raise its rate by 75 basis points this week on Wednesday. There is an 86.5% probability, again, according to the CME Fed Watch tool, that there will be a 75 basis point rate hike on Wednesday. So the market, it's expecting that. Now, there is this 13.5% probability of a 50 basis point rate hike. I don't think that's what the Fed's going to do, right? The Fed already teased us through the supposed leak, right, with the Washington Post. And we're going to talk about that because there was a new article that kind of backtracks some of that December talk. So 75 basis point rate hike. That's what we're going to get on Wednesday. At least that's what I'm expecting. And that's what 86.5% of analysts and market participants are thinking. Yet, on top of this, we have to look at all of the clues together. there has been a slowdown in both the 10-year yield and the US dollar off of their October highs. All right, let me pull up the dollar. Just missed that. Thoughts about zero date? Thoughts about a zero date strangle right before the number gets announced? See, my problem is this time is, in my book, different from all of the other FOMC meetings. The reason why, and let me just keep going down my notes here because I'm almost to the new article in the Washington Post, and this is what makes it hard to try to do any type of move. So bear with me for just a second. If we look here, this is the US dollar, okay? DXY is the ticker. And the red line here, you can see we are off the highs seen from October. We have cooled off. Yes, the dollar was up today. Yes, the dollar was up Thursday and Friday. Yes. But it is still off the October high. And so is the 10-year yield. Now, market participants over the weekend had to digest this article also in the market. This is the Wall Street Journal, and this is the supposed Fed leaker, right? When the Fed wants to get a message out to the public in a non-official way, here's your boy. This is from Nick Timiraos. And the headline here, the risk of the Fed's terminal rate ultimately being higher than the market expects and staying there for longer due to excess savings and the resilience of consumer spending. This completely contrasts with his article earlier last week saying that the Fed could be considering a slowdown in rate hikes. That article is what caused the markets to rally hard at the beginning of last week. Now, the Fed has a long history of overshooting with its rate hikes and cuts for two reasons. Number one, it relies on old economic data like core CPI. Core CPI data, when the Fed gets it, it's already outdated data. Number two, the market's discount, or maybe a better word to use is anticipate that data and the Fed's reaction well in advance. Just like, and let me go back to the chart here, and I'm going to go to the SPX. I'm going to tighten it up just a little bit so you can see that summer rally, just like the summer rally where the market was front running a Fed pivot that never happened. So guess what? The market rallied during the summer thinking they knew what the Fed was going to do next. And Jerome Powell saw that rally, saw the high inflation, saw that unemployment was still strong, and said, nope, you need to go down. I need to put you in your place. I need to put you in your corner, market participants, you're rallying for no reason. And your rally has now made it harder for us to do our job. What do you think Jerome Powell is going to say this Wednesday when he sees that they unofficially try to communicate a slowdown in rate hikes in December, but market participants take it as a pivot in this strong rally? What do you think Jerome Powell is going to do? He's not going to sit there and say, market participants, you got us. You got us. We're going to do that slowdown and we're going to call it a pivot. No, he's not going to do that. Come on. Come on. He's going to see this rally and he's going to think back to the summer rally. And I bet you Wednesday during his press conference, he is going to be as hawkish and as firm as he was last time around. And he is going to strike the fear of whatever into market participants. Look, employment is strong. Look, inflation is still high. Inflation is sticky, and we've got to deal with it, and we're going to raise rates, and we're going to slow this economy down. And you, market, you need to sit down and be quiet. Take your rally and turn it upside down. I could see Jerome Powell doing that. I mean, he just did it with the summer rally. What has changed since the end of the summer rally? Right here. Well, it would work if I had my highlighter. Right here. What's changed in the market from this point to right now? Okay. An easy difference. The market's not as high. The market is lower. It's at 38.71 and it's not up there around 4,300. Okay, there's a difference. I'll give you that. What else has changed since the middle of August? Inflation is still high. Inflation is still sticky. Inflation is still in the 8%. And guess what else? Employment is still strong. The employment rate month over month didn't change. So what do you think Jerome Powell is going to do? He's going to come out and he is going to be hawkish as all get out. Now, the Fed may start to slow down the rate of its hikes going into 2023, maybe even into December. Understand the market has already begun talking or taking that into account, taking that into account. Now, the surprises in data or black swan risks, they usually rattle the market. And that's what we need to be concerned about. Jerome Powell coming out as a hawk because the market has taken off because the market thinks, oh, a Fed slowdown is just like a Fed pivot, and it's not. If the 10-year yield and the US dollar continue to pull back off their October highs, or if they even break multi-week uptrends, then the expectations for both bonds and equities to rally increase. And they increase significantly into the upcoming holiday season. But the Fed is the big one. What's Jerome Powell going to say about December? And this article right here tries to walk it back, tries to say that, wait a minute, Consumers are still strong. That's what they're trying to say here. They're trying to say that consumers still have a long ways to go before higher rates affect them. And if you scroll down and you read through this, I mean, they've got graphs to look at. I mean, this is just something. And look, it says right here, okay? All right. The U.S. Central Bank is trying to slow down economic growth to prevent inflation from becoming entrenched, which it's starting to become entrenched. It's very sticky. To that end, it has increased rates aggressively this year and is likely to raise them another 75 basis points at its two-day policy meeting that concludes on Wednesday. That would bring the benchmark federal funds rate to a range of 3.75 to 4%. Some officials have argued for slowing the pace of rate rises after this week's meeting. But the debate over the speed of increases could is a big word here, could obscure a more important one around how high rates ultimately rise. Will it be closer to 5%? That's what I think it's going to be now into 2023, the beginning of 2023, going to 5%. All right, it continues. In economic projections released at the Fed's last meeting in mid-September, most officials anticipated their policy rate would reach at least 4.6% by early next year. But some economists think it will have to go higher than 4.6%, citing in particular reduced sensitivity of spending to higher interest rates. The big question will be, given the resilience the economy has had to interest rate increases so far, whether that will actually be sufficient. Interesting. So this article is just saying, how can rates slow down? There's too many things happening right now. And look, if we go to the December 14th meeting, we still have that 50-50 shot of a 50 basis point rate hike versus a 75 basis point rate hike. I mean, literally 47.8 on the 50 basis point, 47.1 on the 75 basis point rate hike. Split down the middle. Yeah, also on, and let me just pull this comment up here. Yeah, also on earnings calls, every CEO mentions passing the price on to the consumer. Yes, they do. Yes, they do. And that's not going to help at all. Now, the Dow Jones, the Dow Jones and its blue chip stocks, they led the way in October. They led the way higher in October. The SPY, the MDY, again, that's your mid caps, and the IWM, your small caps, are also faring pretty well with this rally that we saw in October. While the QQQ, it brought up the rear. Mega cap technology stocks have been hardest hit year to date. So they will likely need more time and space to recover. So market participants should anticipate the market to do its normal ebb and flow around key support and resistance zones. The numbers the zones that we call out here on a daily basis. They can help you. Now, going back to today's market real quick, participants received some economic news that played into some stagflation fears. And that's, you don't want stagflation. That's where there's high inflation, no growth, and we're just kind of stuck there, right? China's official manufacturing PMI data, we have our PMI coming out this week. We have PMI data coming out this week. But for October for China and their manufacturing, it came in at 49.2. While its non-manufacturing PMI, which is services, came in at 48.7. A reading below 50 is an indicator of contraction. Their economy is contracting. China's economy is contracting. Separately, the Eurozone CPI, oh my gosh, did you guys see that today? The Eurozone CPI hit a record high, 10.7% year over year in the month of October. That's bad news. That's bad news for us too. Now, back to US markets, rising treasury yields today kept pressure on the stock market. The 2-year, let's look at that one real quick. US 02Y, the 2-year rose 7 basis points to 4.49%. Okay, with that low, there it is. There it is. What's it doing here in the after hours? Looks flat. Yep, unchanged. It is flat in the after hours. Let's take that marker off. It's got this a new high here that we need to watch for resistance. It is underneath that old resistance line right here. Hopefully we can keep pressure. That's at 4.54%. Hopefully we can keep pressure at that resistance, but it is just making higher highs and higher lows. And the 2-year, again, is more sensitive to the Fed funds rate. As long as this continues to rise sharply and the 4-year stays behind, the 10-year stays behind it, that's not good for the financial sector. That's not good for banks longer term. Now, let's look at the 10-year. US 10Y for the 10-year. The 10-year was up also 7 basis points, 4.08%. You can see its trend line that it had been riding so perfectly. It broke down through last week. And now it's just kind of moving sideways, hanging out on that trend line, right on it, and that resistance line that we have there. If it could keep bottled up there, that would be okay. Now, the 10-year, it's more sensitive to inflation and growth concerns. Now, something kind of interesting happened with the 10-year today. Right at the close, this thing bumped up to 4.1%. Right after the close. But it is back down now to basically being flat. So I'm wondering what that little blip was. Wonder if it had something to do with earnings or something. I don't know, but I need to dig into it. I want to know why that happened. Could it have been just a glitch in the system and the data? I don't know, but it's caught my curiosity. Now, this move here with the Treasury market, this move coincided with the stock market also turning lower at the close. Now, mega cap stocks, they had a weak day, leading the market lower, unfortunately. We talked about Apple and how it's such a massive mover, a directional mover for the market. But the Vanguard Mega Cap Growth ETF, ticker symbol MGK, it was down 1.2% versus the 0.8% loss in the S&P 500. Now, Apple, AAPL, let's look at that right quick. They were down 1.5% today, which is, to me, after a big move, you're going to see profit taking, okay? And that could have been what occurred with Apple. Now, this is the updated weekly expected move for Apple right now. Right now. I included it for today. So I wanted to look at that. The lower end of the weekly expected move for Apple is 149. The upper end for Apple is 162. That area is interesting. It would put Apple above its 200-day moving average if it reached that level. Now, Apple is still above its 50-day moving average, which is at 151. That 200-day moving average is at 156. So it's in between there. And even though it was down today, it's really gone nowhere. A big drop in the morning, and then it closed not too far off from where it opened. Now, this example right here, this pattern, right? Where'd my cursor go? All right, so this pattern is neutral, okay? It's got a little body on it, and it's got equal wick on the top and the bottom. This is called a spinning top candle. It is neutral. It means that it could literally go any way. It could go up, it could go down. But that's a spinning top example right there. And it's neutral. Okay, so keep that in mind with Apple. It is also above that inclining 5-day EMA. And it's not quite connected. It's a little disconnected. Why did Apple lose 0.5% today? Well, the majority of it probably was profit takers. But some of its losses could be attributed to a Reuters report that COVID measures in China could negatively affect their iPhone production volume in November. At its company, what is it? Foxconn. All right. So that news report came out. That could hurt Apple as well. Now, if we go and look at sector performance, it was pretty broad-based today. Let's open this up. You see a lot of red, top right corner of your screen. Let's take it all the way down to the dollar. And I'll cover the dollar back up. We already looked at the dollar. All of that red, only one of them was left green today. So communication services, ticker symbol XLC, was down 1.7%. Technology, XLK, down 1.3%. They brought up the rear. But could you guess what the winning sector was for today? Energy, XLE, up 0.6% during regular cash session. It was the only sector in the green. Now, it was reported that the Biden administration might be considering a windfall tax on energy producers. Although there was a follow-up to that report from the Associated Press that suggested that tax is not likely to pass because it would have to go through Congress. So, WTI crude oil futures. It's U.S. oil, one word, no gap, on TradingView. That'll take you to WTI crude oil futures. They fell 1.6% today to 86.50 a barrel. Okay. So it is still relatively in this chop box moving sideways. That's not good for CPI data. If we have CPI at, let's just say, 8.2%, and it does nothing but move sideways. Let me see. If I put a box like this, okay, I want to make it a little bit bigger than that green box, but a box like this, all right? That box right there is going to capture 99% of the price of oil. So just to put this in perspective, this started, well, let me move it forward just a little bit. All right, this started, let's just say, at the end of July or the beginning of August. All right, August 1st, okay? All through August, all through September, all through October, what has oil done? It has chopped around up and down in this box right here. Is that good for inflation? No. Looking at it this way and thinking at it from this perspective, you might think that, you know what? How are we ever going to get out of the 8% on inflation if oil is just moving sideways, chopping around? That would be a fair question to ask, and a question that is showing you on this chart how sticky inflation is becoming, because all we're doing is we're taking a bit off of this really high area here at the end of August and this really low area here at the end of September and averaging it all out. Oil price isn't going anywhere, which means neither is inflation, because energy is a big component of inflation. Now, core inflation, that's different. Core inflation, you take out food and energy. But with the oil, or I should say with the energy complex today, natural gas futures, which are going to be rough on Europe this winter, they were actually up 10.6% today. That was a pretty big move. Now, economic data, it was limited today to the October Chicago PMI, which came in at 45.2. Expectation was 47.1. This shows contraction continues. This shows the economy continues to slow down. Anything under 50 means contraction. That means you're not growing. Okay, looking ahead to Tuesday, market participants will receive the following economic data. At 9 o'clock a.m., we will get the September job openings, or JOLTS. The prior reading was 10.053 million jobs opened. I surmised that the reason we had dropped from the 11 millions to the low 10 millions is because companies pulled their job openings without filling them. Then at 10 o'clock a.m. tomorrow, 10 o'clock a.m. Eastern, we get construction spending. Anybody want to guess what the expectation is? I'm sure if I were to say, do you think the expectation is growth or contraction? I know what you'd say. Contraction, because it is. The expectation is another negative 0.5%. The prior reading was negative 0.7%. I'm actually surprised it's not bigger than that by now. But we need homes, so they got to keep building them. It's just people are getting priced out of these homes, the left and right and center. And then we get the October ISM Manufacturing Index. The expectation is 50%. The prior reading was 50.9%. And remember, I think I've said it like 4 or 5 times just in this live stream, 50 is the expansion contraction number. Anything below 50 is considered contracting. Now, on the earnings front, we get a whole boatload. We get BP, Eli Lilly, Foxconn, Lear, Marathon Petroleum, Pfizer, Phillips 66, Simon Property Groups, Cisco, and Uber. They all headline earnings reports before the market opens. Now, earlier today, we sent our private investor community a preview of Uber's earnings report. So our investor community could take that information, digest it, and know whether they want to try to take it long or short or pass on Uber's earnings report. So that preview is with our investors. SoFi, I see you there. SoFi too. I will definitely be watching for SoFi to see how they do. SoFi, win, lose, or draw on their earnings report tomorrow, I still think SoFi is an investable company. Okay. And one of the easiest things to do in a time like this, when you're not a trader, you're solely an investor, and you're not sure whether you should be buying right now or holding your cash or what the case may be, you can use technical analysis to find areas that are active, all right? Without knowing how to do any technical analysis whatsoever, you can find areas that are active, all right? And you can use the dollar cost average strategy to buy shares. When price action brings it down to an area that has a lot of reactions on them, buy a little bit. Like, have a monthly goal set aside for investing. Okay? Or budget X amount gets set aside each month for investing. Put it into your brokerage account. When a company that you like comes into an area that is either much lower than before, or even just a little bit lower than before, like for SoFi here, it seems to be having a low somewhere around 4.8. Okay. So whenever it gets down to 4.8, you buy a few shares. And you continue doing that until the money in your brokerage account is all spent. And then the next month, you do the same thing. You budget how much money you're going to put into your brokerage account to buy stocks, and you put it into your brokerage account. And you can set alerts so when a stock reaches your buy point, then you can jump in, double check what the chart looks like, and you can buy a few shares and just continue to do that over time. So then when we get to our next bull run, when we're officially out of the bear market and officially now into a bull market, your cost basis is going to be much, much lower than someone who tried to, quote, time the market and get 100% back in to equities at the exact bottom. Okay? So set a budget aside, put it in your brokerage account each month, and then the companies that you like that are on your shopping list or on your, these are the companies I want to own for the next decade, then set a stock alert at a certain price point. When the stock reaches it, that alert goes off. Open up a chart, look to see what's happening. Is it trending down? Is it just a consolidation move where it's moving sideways? What's it doing? And then you can go in and buy a few shares. That is the way to set yourself up to have a great cost basis for a great company that you plan to hold for a decade or longer. Okay? And you're not worrying about the day-to-day price action of the stock. All right. If you have any questions here, we can go over those. Otherwise, I'm going to go through and give you the weekly expected move for the major indices. Also, I just want to mention here, I don't have the chart pulled up. I'll bring the chart tomorrow. At least I don't think I do. Weekly expected move, earnings, candles, S&P. Oh, wait, is this it? This is, I wanted to pull this up. Okay. I meant to pull this up earlier. I totally forgot. I forgot I had this chart here. On Twitter, at Almanac Trader, he posted this. That dude he's awesome. This is a great guy. Knows his stuff. Also publishes the book Almanac Trader every year. It's a good one to buy. It's got a ton of techniques in it. I love it. Absolutely love it. But anyways, this is showing the S&P 500 monthly percent performance. This is going from January of 1950 to April 2022. And what does it show here for November? What does it show here for November? And November is this box right here, okay? And just to be clear, see November, line those up right there. It shows that the S&P 500 monthly percent performance is 1.7% in November. That means November is the best month of the year. Okay? But what does it say for December? It says December, April are also two pretty good months. And then it's got, which I find interesting, July down here at 1.1%. Well, that's interesting. And then the only 2 months with losses, we've got September, which is the biggest loss, and we've got February, which is another loss. So staying in this market here, even though this market is very volatile, crazy, and unexpected at times, it's better to be playing in this market in the month of November, December, April, July, March, January. It's every other month that you have to kind of be careful of. So October is almost in there, at least with 1%. So I thought this was an interesting chart. Just wanted to share it with you guys. So you've got it. If you go to Almanac Trader on Twitter, he's always posting very interesting stuff there for us to look at. Okay, so let's go back here. Oh, real quick, Bitcoin. I meant to point this out on Friday, but I forgot to. As the charts load here, you'll notice something. Several months ago, I put a marker on the Bitcoin chart just to kind of say, hey, this is where I think it's going. This is where I think it's headed. And it nailed it. I had this yellow circle here, and Bitcoin came right on through and moved through the top 1/4 of the circle there. I thought that was real interesting. Real interesting indeed. All right, let's go over to the SPX, the SPY, the Qs, the IWM, or the Qs, the DIA, and the IWM. All right. With the weekly expected move and price points that are interesting to look at. Okay. Also, your questions. If you have questions, plug them in as well. I'd be happy to go over those as well. All right. So we've got. So you think Jerome lowers his tone, seeing how the market rallied really hard in the past 3 weeks? I feel he maybe not. I do not think Jerome Powell lowers his tone. I think Jerome Powell is going to be more forceful than he was in September. Okay? If we remember, it was September the 21st. September the 21st. And if we actually, I'm going to put a an anchored VWAP on the 21st. Wait, was it the 21st? Oh, yeah, I'm just in the wrong. I'm in August. There was no meeting in August. All right, September 21st. All right, let's put an anchored VWAP there. And it's interesting. That anchored VWAP, the quarter to date anchored VWAP, and the 20-day moving average, they're all coming together right here, right there. That's real interesting. So we had some, obviously, the summer rally, okay? We had that rally. It stopped out at a technical high here. We had some bad data leading into this, and then we get Jerome Powell, and the market dropped on September the 21st is when we got the interest rate, and the market dropped 1.7% on the day. If you remember on Friday, our rally on Friday tapped out exactly at the top right here of the last rate hike decision day on September the 21st, when Jerome Powell came out and speak. On Friday, that's where we rallied to and we stopped. So I find that very fascinating. The SPX is above that 50-day moving average, but right now we have a market that is rallying. We have employment situation that is still strong. Unemployment month over month, it didn't change. And we have inflation that's sticking around. What will Jerome Powell do with those three things? Knowing those three, their mandate is full employment and inflation with a yearly average of 2%. Well, employment is fine. So right now, it's like they've got one mandate: to fight inflation. And we've been saying this for months. Jerome Powell will need to come out hard against inflation, because inflation has not become tame. Jerome Powell and the Fed have not tamed inflation. It is still high. And with the Eurozone just now reporting its highest ever inflation number ever, these things do not, at least for me, point to Jerome Powell changing his tone and becoming dovish. I just do not see it. Maybe I'm blind to my own bias here, but what's changed since September? What has changed since the September meeting? The stock market is at the exact same place, okay? Actually, let me clear this up here, and so I can make it as crystal clear as possible. This is the question. I think this is the most important question to ask yourself about inflation. Now that I've got this cleared up, now I'm going to put two circles on here, okay? Here's the first one, right here, okay? Right here. And I ask you, what has changed since the last FOMC meeting? The stock market is literally at the exact same place that it was at the September FOMC meeting. Inflation, core CPI, has gone up since the September FOMC meeting. Employment has stayed the same since the last FOMC meeting. So what's the Fed to do but remain hawkish or even become more hawkish? And if the Fed becomes more hawkish, like we said a little bit earlier in this live stream, uncertainties in data and black swan events, those are the two things the market can't handle. So if the Jerome Powell says, okay, the market's exactly where it was the last time we did this, inflation, core inflation, oh my goodness, it's gone higher since the last time we did this. Unemployment, it remains the same since the last time we did this. All data is pointing at we need to rug pull this market. We need to give this market something it's not expecting. Let's raise these rates by 100 basis points. Let's do it. Or they're just going to keep it at 75 like everyone thinks it will. And then he's going to come out and shut the door on a potential slowdown in the Fed for December. That's his only two choices. Because remember, the Fed gaining back its credibility, for the Fed to gain back their credibility, they have to put inflation down. They have to get anything back. Let me go ahead and throw this up on the screen here for everyone. Yeah, other market participants make me question my own thesis when they're all saying Fed pivot pause. Oh my, I can't, you know what? It gets under my skin when I'm watching mainstream finance press or watching other YouTubers and they're like, oh, Fed pivot or Fed pause. Like real big YouTuber, Meet Kevin. He had a video the other day, and I think it was titled something about Fed pivot, or the Fed's gonna pivot. The Fed's not gonna pivot. Come on, man. I think half of the time, some of these YouTubers are doing Fed pivot is because market participants have all been, what would the word, conditioned to know that when the Fed pivots, the market rallies. Okay. And part of the problem, obviously, with the summer rally is that market participants were thinking, oh, inflation came down a little bit. It's still historically high, but it came down a little bit. So Fed pivot, anyone? And market participants were sold on that story. But unfortunately, it didn't happen. It's not going to happen. And I'm going to stick to it. A Fed pivot will not happen in 2022. I get your other point there too about having an expectation, having a market thesis, having a plan, and then having your conviction be tested. by listening to other people in the finance space start to talk different than what your own market thesis may tell you. And you start to wander a little and you start to overthink and overanalyze. What have I done? Did I have my own bias blinders on keeping me down this path? Have I thought of everything clearly? Yeah, you have. You've done the work. As long as you've done the work, you've done your own due diligence, you'll be okay. You will. Knowledge is seriously the key to everything in life. If you want something in life, knowledge is your way to get there. I'm a firm believer in the phrase, knowledge is power. I teach it to my kids. My kids know it. Knowledge is power. If you want to know anything, if you want to go anywhere, knowledge is your key for doing it. So, again, as long as you've done your own due diligence, you've got that key to unlock that door. All right. Let's see here. All right. So for the SPY, let's go over there after I clean this up right quick. One more click. All right. So we did the, no, we didn't. All right. For the SPX, the weekly expected move is 4,018 on the top. On the bottom, it's 3783. Now, where the market is right now, it closed at 3871. The problem right here is the 3900 area is a very, very sticky area. And it is going to be really hard for the market to get much higher than, say, 3930. Okay? This zone that it's in right now, and it's on the bottom half of that zone, it is really sticky. So we're liable to trade sideways tomorrow. It could be a little bit down, it could be a little bit up, but in the grand scheme of things here, it's going to be sideways. Okay? It's disconnected from the 5-day EMA. It needs to reconnect with that. So I just say it's going to move sideways to this blue trend line over here tomorrow. So it's not maybe a few points up, maybe a few points down. It's hardly going to go anywhere. Today, we dropped about 30 points. Not a whole lot. All right. So we've got that. And if I pull that up for the SPX, its weekly expected move is plus or minus 117 points. Okay. All right. So let's go look at the SPY and call out these points here for it as well. All right. Let's see here. All right. All right. Come on. All right. Well, there we go. There we go. Okay. For the SPY, the weekly expected move on the top side is 400 even. On the bottom side, it's 377. Okay. 400 and 377. It was down 0.72% today, so it's really moving nowhere. And just like the SPX, it's in this spot exactly right here. There's this little zone here. And I'm trying to put this line right here in it. I'll make that red because it's resistance. It's kind of like at the top of this zone right now. But breaking above this, if it were to somehow, if we were to somehow get a rally, if Jerome Powell went completely against everything that I think my investment thesis is telling me, then obviously I'd be shook, and I'd have to rethink things. But it would lead to a rally and breaking over 400, and then boom, we would be way over 400, shooting up to about 410 real quick, because there's not much resistance above 400. But we have to first get above where we're at, about that 390 area is kind of tops, and then it comes back down a little bit to about 385. So $5 zone there. Now excuse me there, the oh, what was I going to say? Oh, the weekly expected move for the SPY is about $11 or $12 on there. Let's see. That disagrees with the other red line chart for November. Yeah. Well, let's look at that. See, I think right now, for the seasonality chart, let's see here. For midterm elections, November is very choppy, and November is, if we try to put a trend line on November here, for the S&P 500, oh, I don't want a dot. I need to draw a line. This is trending down, okay? So it's choppy, but it trends down just like that. Now, if we put that into play, say we're at our high right now, right? Why did we get this high in the first place? Well, we got this high. A lot of it, at least half of this rally, came from that Washington Post article saying that the Fed is thinking about slowing down, and then misinformation being spread saying a Fed pause or a Fed pivot in December. And that got people rallying and jumping back into this market. So what if this is our top, and now for the month of November, we're going to chop around, but we're basically just going to end up, moving down, right? And that's exactly what the November lines would be saying here, okay? November is saying that we would be chopping around, but the overall trend would be down. We can chop around and still have the overall trend being down, right? Look at 2022. We have chopped around, but the overall trend, right, for the SPY here is down. All right, let me delete. All right. Give me one quick second. I'll pull that chart up. about December being the best month. Okay, let's see here. All right, now this chart right here, the S&P 500 monthly percent performance, January 1950 to April 22. So this is average month to month percent change. All right, it's a little bit different than this chart right here. And the reason so, I need to explain this one better. Okay, this is going from, for example, the month of September right here to the month of October, and what's the percent change between the 2 months, right? So in October, the month over month percent change is a plus 0.9. All right. So we could be in a hole like it shows here for September. And by the time we get to October, it should be a 0.9% improvement in that month. Now, let me clean that up a little bit. So November here, it's got a 1.7. All right. So monthly percent performance, and it's an average month to month percent change in S&P 500 based on monthly closing prices. So for November, and the 1.7 right here, it shows it's the best month out of the year. Now, with that said, let's go over here to the actual chart to kind of explain that. And I'm going to do that right here with two things. First, I'm going to go to a monthly chart. Okay. And it's going to look kind of weird, a monthly chart, because it's got a whole bunch of stuff on it. But on a monthly time frame, wow, what a big drop we've had so far. All right. So a 1.7% change month over month. All right. So we end October. I want to line it up here real good. Okay. Now, if we go up 1.7, which isn't a whole lot, I can get 1.8. I can get 2%. All right, there's 1.8%. Not a whole lot, okay? That takes us, what does that take us to? $6.9 on the SPY. Is that right? Yeah, $6.9 move on the SPY. Okay, according to that chart. So we should, in the month of November, that much higher. Let me do that one more time. I want to see where that dollar amount is. All right, there. And now we go 1.7. It always jumps. It goes 1.5 to 1.79. Okay, 1.79 puts us at 391 on the chart. Let's go back to a daily view. 391. We are at a 386 right now. So what that chart is saying, from right now to the end of November, we should be on average at $391. So let me put a mark over here, the beginning of December, and at 391. So that blue dot is where we should be at the month of December 1st. All right, let's go look at this chart. Now for November, let me clean it up here. We start October high, right? And then, I'm sorry, November, my apologies. We start November high right here, okay? And then we downtrend to basically the end of the month is what this one is saying. However, there could be another way to look at this because remember, this isn't a one-for-one matchup on date. It can wiggle around a week or two. So what if this rally that kicks off here in December, what if it kicks off, let's just say, a week earlier, right? So what would that look like then over here? If one chart says we should end up being 1.7% higher, okay, at the end of the month, that's not to say that the month doesn't, look like this. And then end with a rally, right? So in the middle of the month, it can go anywhere. And I don't think the two charts are contradicting each other. I just think that this chart right here, which has been so super accurate all year long, since this October low came in at like the middle of the month, I think it was October 13th I think it was 13th. And then that left the rest of the month to rally. So that ultimate low was more towards the middle than it was where it ended up here on the chart. So if everything is pulled forward by about 1 week, right? By about 1 week, then that means the start of this rally for December, it may be pulled forward by 1 week, right? That would then allow for this 1.7% month to month percent change to be accurate. Okay, so that's how I'm getting these two data points to align. Okay, one is saying that X will happen. One is saying this is the average path that we have taken, and it has been pretty accurate all year long. But it could be pushed forward or back in time by like maybe a week, 2 at the most. I really think the biggest change was that super low in October. It wasn't so far towards the end. It was actually on the 13th of October. So a little bit pushed forward in time or pulled forward in time when that happened. So that's how I get those two agreeing with one another. So I hope that helps. Okay, so let me show you then the weekly expected move for the Q. And we'll get this wrapped up here. You are welcome. Thank you for your questions. I greatly appreciate them. All right. With these loads, and if I need to, I can look at them over here. All right. So for the Qs, the expected plus or minus move is about $10 and all right. Just need the lines here. All right, so the upper end of the weekly expected move is right about 291 for the QQQ, and the lower end of the weekly expected move is 270. All right, and then let's look at the IWM, and then I will have wrapped up everything on my notes. While the lines load here, if you could click that like button, share this video with a friend. Those two things helped out. They help out greatly, and they have helped out in the past. If you like the perspective, click the first link in the description. We've got a ton of information. I think it would. I think you'd like it. I really do. Okay, for the IWM, which is like your Russell 2000, this is trading small caps. It's been really outperforming over the past month. The upper end of the weekly expected move is 189, which is just above that 200-day moving average, which should be a little sticky. And then the lower end is 176, which is closer to its 50-day moving average. So if the Fed is over hawkish, we'll probably definitely test that bottom line. Let's see here. Let me put this up so everybody can see. Adam, based on your daily explanations and insight, my daily success rate for the last 5 daily scalps I have done, I have been successful 100%. Today, another 316. Thanks. Oh, you are absolutely welcome. I am super awesome that has helped. Wow, that is really cool. That is really, really cool. Awesome. Awesome. I am extremely happy for you. That is great. Well, this makes for a wonderful note to end today on. I'll be back here tomorrow after the market has closed to talk about what happened, why it happened, and what to expect going forward. Tomorrow, it's just going to be a chop fest. Again, we'll chop around. I think we have a 50-50 shot of being green or red tomorrow, but in the grand daily chart, I think we're just going to be moving sideways tomorrow, so I'm not really expecting a whole lot for tomorrow. Now, tomorrow's close, I think, will be more interesting than any other part of the day, because sometimes, somewhere, data can get leaked on purpose, on accident. I'm just saying. Sometimes it can get leaked. So if the market starts to sell off rapidly, then it's either people preparing for an overly bearish Fed, or somebody knows something. So watch tomorrow's close carefully. Obviously, we'll report on it when we go to our live stream, but watch for that. All right, cool. So that's tomorrow. Again, nothing major. Just moving sideways, I think, in the grand scheme of things for tomorrow. But Wednesday will be important. Wednesday at 2 o'clock. That's when the press release will come out, and 2:30. That's when Jerome Powell will come out and give a speech. We need to hear from him on December, right? Is he going to be overly hawkish, or is he really going to have a bearish tone and slow down rate hikes? So it'll be a critical day on Wednesday. But we'll have another day to talk about it and to work through it. So thank you guys and gals so very much for hanging out with me. I greatly appreciate it. I'll see you back here tomorrow after the market has closed. You have a wonderful evening, and I will see you in the next video. Take care.